welcome back to my channel. So this is RJ Trades, and if you have not subscribed, please do subscribe and like and click that bell button so you get update about all the new videos, and it helps me. And also, I always is asking a lot of, if you have any questions or if you want me to make any particular video, just comment below and I'll make one. In this video, I wanted to start from the beginning. A lot of people are still confused with the options, what is call options, when to buy, what strike to choose. So we're gonna kind of go over all those things in this video. So if you are beginners or even like intermediate and you are still confused, maybe this is the video for you. So let's get it started, right? So this is Roku. The Roku had a huge run up, 11%, and looks like after hour they're 1% down. Let's see how's the tomorrow fold. So when you are trading, this is of course Robinhood. You can choose whatever broker you like, but so we are in the call. So this is called option chain. So option chain is basically nothing but you have 165, 167, 170, 172. These are all the strike price. These are strike price. And if you see that strike price, right, so Roku is 163. If you buy call option for August 28th, that is buy call. If you want to buy 165 strike, you gotta pay almost 300 bucks. So this is 298, so you gotta multiply this number by 100, cause option, basically an option is one option contract is for 100 stocks, 100 underlying. So what you are saying by 165 call strike, basically that means you can buy. So this is the premium, right? You don't know what's gonna happen, price gonna go up or down, nobody knows, right? So if you are buying a call option, what you are saying is like you are betting on it, like the price gonna move up, right? When the price gonna move up, you are saying before or on 28 or before. So what you are basically paying, this is 298, it's also called premium. You paying $300, like let's make it $300 for easiness, just a $2 less. So you're paying $300, and whatever, if it goes anything above it, you make some dollar, but your break even price is to just break even, cause your cost is 298, you already paid, so it has to reach 167.98, almost 168. If it reaches 168 by August 28, at least you are break even, right? At least you are a break even. If it reaches anything above that, right, that's your pure profit. That's why this is basically like, let's say it's open like 165, let's say 170, right, and on August 28, then you made literally $5, right? That this is a straight call, this is not a spread. We are talking about straight call right now, just kind of going through different terms and whatever. So to break even, it has to move 2.92. So that's the percentage it needs to move, right? Or percentage today it moves, so that is the today, however it was moved, 1095%. So basically from yesterday it moved 275. So if you got in yesterday 165, it was like probably 75, so 25-30 cents, right? So if you got yesterday 25-30 cents, you could have banked today a lot. So let's look at few more terms. Bid ask. So bid is whatever the buyer, so buyer wants to buy at 295, but seller is asking $3. That's why a lot of times people's option is not executing. You need to look into the bid ask, right? What's the difference, right? So this is tighter the better. If it's 295, 296, 297, that's good. 295 3 is not bad actually. If you go a lot of high price stock like Tesla, Amazon, they have literally $5 or $6. Actually, in other terms, bid ask 295 3. You are losing each time you transact. You are losing $5. It doesn't really matter if you are making hundreds. Like you made 200, so you lost 10. I mean, not a big deal. But if you are working with a huge quantity, it does matter. So that's bid is buyer. That's what buyer wants to buy it. Seller, that's so basically you said 195 and a buy. There's no seller, so it's not gonna get filled, right? A lot of times like, hey, I'm trying, but it's not get filled. A lot of people ask like, why Robinhood or something not? It's again, it's everywhere. If the bid ask is wide, doesn't matter wherever you go. There's a little bit like some brokerages have faster execution, so there's some, but you this is all about liquidity and the price. This is mark is the midpoint, just the midpoint of bid and ask. Previous close was, what was the previous yesterday? It closed at 23, and today's high was $5.28, low was 42. Even if you got in today, it was low at 42 cents. And volume, this is very important. You want to trade something which is a high volume. Whenever you are looking at the strike to, let's say you are looking at 225, right? It has some volume but not that much. 245, it's like, it's a yucky kind of 50. You probably don't want to trade. So you gotta always look into the volume, right? You want to trade something which is a higher volume. Open interest, I covered so many times. Open interest is when you buy, it gets added to the open interest. When you sell, it gets subtracted. Again, some people actually, that's opening and closing position. Some people actually sell first and buy later. If you sell first, you have to buy back, right? So unless it expires worthless. So when that happens, again, it's the same concept. Implied volatility, what's the volatility? That's like, so it could go 68% up and down. That's what it's saying. It's whack like a little high, but it kind of tells the option price, like that's how the option price is determined by the IV. If it's a really high IV, the price are really expensive. Usually it would be like 20, 30, but these days like everything is really highly volatile. That's why. Now the Greeks are important. I've covered a lot of times, but let's repeat again. Delta. Delta is basically nothing but for each dollar move, right? If the stock, like right now, what's the price? 163. If it goes 164, your option price will increase 295 plus 47, so probably 340 45, right? So around $50, right? For each dollar moving stock price, your option, you get $50. And this gets bigger and bigger as you get the expiration, right? So as you arrive, it gets bigger. And this also changes. A lot of people are confused, does it change this whole day? It does. It does change as the price moves, it changes. And as the volatility decreases, increases, changes, it goes down, it changes. So it changes, right? Gamma, what is gamma? So for first dollar, it's 47. So your next delta will be this plus this. So it will be probably 51. Second, whatever the gamma plus this. So as the price goes up, your delta will increase. So how much it increases is basically delta plus gamma. So that's the next dollar increase. Theta, what is theta? So if the stock open flat, you subtract this. That's why its theta is negative. You subtract. So 275, if let's say theta was 75, if the stock price open same as today, tomorrow it will be $2 only, cause you gotta do 275 minus whatever this is here, 82. So whatever it is, like 211, right? 210. So this is theta, is basically each day you hold. So basically each day, if it's open flat, you are losing $82 in this particular contract. Rho is rate of interest. Vega is from implied volatility. Don't worry much, this is low anyway. So yeah, Vega is basically change in volatility. So 1% change in volatility will, if it's up, then it's gonna increase by 0.05. And if it's on the option price, if it's down, it's gonna reduce it. So that's why it is. Now a lot of people are asking what strike to choose. Should you choose weekly? Should you choose, and why to do that, right? There's a lot of strategy, right? For example, this is August 28th. It expires in literally 2 days. That's why 165 is, it's cheaper, right? It's cheaper. So tomorrow, if it goes $10, let's say if it goes 63 to 73, so you almost like $8 in the money. So this will be at least like $8 to $10, right? And that price you made 300%. So this is risky too, but if it's open flat, you lose money. So with the near expiring, if you don't have much longer period, your theta is really high and you lose money if it's open. So it has to be bullish, it has to go up up up. So that's why. So if you're really bullish, you can buy certain term, but other than that, like if it's flat or something, it's, you're probably gonna lose money so much. So I mean, if you got yesterday 25 cents, that's a great, right? You could gamble maybe $100 and make it like 1,500. You could do that if you got Roku yesterday. In fact, you have made it. But in the long run, what I suggest is go at least 2 weeks, 3 weeks out. A lot of people actually, the best strategy, what happens is like the theta decay. initially if you have, let's say, 1 or 2 months out options, right, theta doesn't decay that much in the initial period. For example, let's look at something. This is August, so September, October. Let's look at the October 16, right? October 16, let's say 65. It's expensive though, cause you have a lot of time. It's $15. So if you look at that, look at theta. For tomorrow, it's what, 95 here. You're losing money, but you're losing $15. So let's say it's good in the sense is like, let's say it remains flat for 5 days, you lose like $75. On the other hand, with that options, you lose 75 or $80 in one day if it opens flat. So I think it makes sense. So what do you want to do, right? And yeah, I usually try to go and other thing is like deep in the money. Why deep in the money? For example, 165, if you got 150, right, your delta is higher, 69. But if you got something like 170, your delta is 49, right? So what does that means is like, if you buy deep in the money, each dollar increase will give you more money. Your option price appreciate quicker. Whether if you're out the money, it's slower, right? That's why. And either it's of course expensive. 150 is 23 $2,000. Here you're paying $15, but each dollar increase you make pure profit. And the other thing is like, just to break even, right, 70, let's say you got it, just to break in, it has to move $7. Whereas in this case, if it moves $7, you already made like and break even price will be probably a lot lower too. Like 150, 173 is break even. Here 70, not break even, it's 83. So if you make 73, you are losing money. Here in this case, if it reaches 173, you're making money. So that's that's how you kind of. So the suggestion is like, maybe if you are starting out, go 2 weeks 3 weeks out, right? Let's see, and don't play large, play small, right? Play small stock, play don't pay too much money, right? Maybe 200 $300. Other things, a lot of peoples are like spread, right? Why to do spreads? And okay, the reason you do spread is risk management, right? If you do options, let's say if you do option naked 165, right? So 165, it cost you $1,500 for October 16, of course. It cost you $1,500, but the but your profit is unlimited. I mean theoretically, because whatever above 180, right? Break even is 180, but whatever above 180 is your pure profit. In theory, it can go to 1000. So if it goes 1000, that's all. Literally, what it's meaning is like, even if the stock price is 1000, you can buy at 165. So whatever else is your profit. So that's the good thing about naked. Your profit is potential, right? Unlimited. The risk is you could lose. You have to pay big money and you could lose, right? Like usually not stocks goes that high or it doesn't go. Whereas why you do spread? You spread one thing to reduce your cost. Let's say you're gonna do 165 to 70. So what you are doing, you're buying call 165 and selling call 170, right? So your total cost is $218. See, look at that. If you had bought like 15, this one was $15, but the same expirations. If you make it spread, it's $2. But your profit is, what is your profit? Your profit is the width times 100 minus the cost. So basically your profit is 165.70. That's a $5. So $5 width, which is 500 minus 218. So you can make it 2x here, right? It's so your profit is capped too. What I mean by capped is you cannot make more than that money, your max profit. And the other thing is like, for example, if it reaches like, let's say 170, right, like tomorrow, you won't get 500 tomorrow. It's slowly, cause you have a time value. So you bought one but you also sold one, right? So this value increases, right, but this value also increases, and whatever you are making is the difference between these two. I mean, here's negative, but yeah, just add it, you can do, but your difference is this net positive number. So that's why uh, your max profit is also capped, but your cost is 2. You can literally, but what you can do is, instead of getting 1500, you can get 5 of those, right? That way you can make a profit too. But other than that, if it goes down too, since you have the sell leg too, that's why it won't go that drastic down. For example, if it goes down the naked, it just lose money so quick, cause a lot of things here. Theta one, here theta it's working against you, here still it's working for you, so kind of compensate itself. So these are the things. Also IV cross or whatever the option, you have the both legs, right? So that's doesn't matter much, right? If the price moves, both the price moves, so the net you'll be like kind of, it's a good risk management strategy. So yeah, so we covered that. What else I need to cover? Yeah, so basically you got it right. When what are the benefits of taking naked, what are the benefits of taking spread? Yeah, put it just the opposite. I can put it, but a lot of people's gonna get confused, so I'm gonna make other video where I'm gonna talk all about puts, but this is purely about call. um, Anything and other things, right? A lot of people is like, when do I sell? Should I sell it right now? It's like 20%, 30%. Again, it's your decision, right? When you want to sell. I mean, it's, you got to decide when you want to sell, because you got to know when you bought it. And when you buy, usually you buy for a reason, right? Let's look at this chart, right? This is CRM. It was a trend line. So if you are trading a support from this trend line, so this is support, right? This goes up and goes down, this acts as a support, this acts as, so if you're trading off here, I mean, if it, you probably wanna sell if it breaks this, but it doesn't break, right? So you should keep riding it. I mean, so you gotta know like why you traded. You traded for a reason. If you trade like blindly, like, oh okay, it's gonna go up, I'll tell you, you may make money per month, 2 month, 3 month, but ultimately you will lose money. That's the fact. But if you trade up some catalyst or trend line, some technical patterns, you should do better. And also you should always know when to get out. For example, if you are working of this trend line, if it breaks right here somewhere, you should get out, right? It broke, it's in a downtrend or something. Again, you need to have a little bit of wiggle room, because a lot of time it touches and then bounce backs, but you got the idea. So yeah, I think that's about it. That's all most of the people's have question about. I'll make other video. If you have any more questions, comment below. That's it for today. Thank you. Don't forget to like and subscribe.